The idea of a digital asset world and distributed technology, or AI, that allows you to do things in a more distributed way and say, have your model on device where it doesn't have to go to cloud even. Most things are moving distributed. Most things won't need to be moved as much as represented in a database. Regulation is a huge part of that globally. Crypto itself will find our place, I believe, in the digital asset world in 25, with real kind of partners and challenges. And, we're more of the belief that TradFi and DeFi are going to blend and have a spectrum versus there's a cryptos taking out fiat or everything's moving to token from analog, and all of those things are going to be more spectrum over time and incremental changes over time.
What is the Symphony Innovate event?
Innovate is a somewhat annual event that we have. We've had, I think, 13. This is our 13th Innovate. We're a 10-year-old company. And it's really just a way to showcase what we're doing. I think it's evolved over the years more from our showcase on product to an industry showcase that we happen to really drive and participate. So a few years back, we sort of imagined what we were doing as a firm strategically, really pushing more into the markets, less about functional things like chat, more about settlement problems or KYC or margin collateral. So really looking more deeply at markets and how we can participate, create value, and obviously sell more product because of it. So for the last few years, the Innovates have been sort of building from vision to execution of that strategy to the actual products really coming through. And I'd say the last two Innovates were very geared toward our partners and our clients showing how they use us. And then we've created nice arcs through the whole event that show some common themes. So the last Innovate we just had on April 18th, there's a number of demonstrations that show us embedding in different technologies, which is somewhat of a new product for us, where we don't just have a Symphony box, but it's more our technology could be embedded in different user interfaces and backends. So that was a big profile for us where, think of the 13-ish demos, 5 were what we call ECP, embedded collaboration. And then the other arc that was common across was 2 really the back end, more middle to back office initiatives. And we went to market pretty formally with DTC now on settlement exception management. And then underneath that was a lot of data discussions, obviously, from AI to transcription to noise canceling technologies. So anyway, a lot of real product pulling through our vision and strategy for a few years, kind of crystallizing in a 4-hour moment that people really felt like an industry event to people more than a Symphony kind of an Apple day, which was sort of how it was fashioned a few years back before we got a bit more in the markets, I'd say.
What was the discussion around T+1?
Depending on who you talk to, it'll be a nuisance / somebody will deal with that for me. It's from maybe a buy side that outsources a bit to this is going to be a disaster and the market's going to fall over on day 2. Usual outcome is it's never really either of those things. So T+1 hit on May 28th. Mexico actually went May 27th as a market. There's some challenges on the rates of actual good confirm on day, right? So I think they were maybe 89, 90%. Now they're edging up to 99, 92%. So it's still a very large number of transactions that are not getting through on T1. I think one of the things that people are sort of assuming now is when you move to T1, you're effectively at T0 or real time because you just don't have that data have an error, right? You move to like a 28-hour to a 4 or 5-hour window. So you kind of need to know it's good going in. So we'll be active in this exception handling as the market figures out how to make sure it's good data in. But that could get back to account management, like account setups for sub-accounts. It could get down to SSIs, settlement instructions being available, not too dissimilar than other markets beyond securities, but there's a number of things that will probably have to happen to change process and get better data in so that it's less likely to break or be at least accepted on the other side. So we're embedding in their OMGO platform, the CTM, the central, I don't think they call it OMGO, but the central trade match. So we'll be in the UI. It'll just be a better way for people to basically escalate the fact that something is failing. And then a lot of firms will start to plumb into the back-end APIs from that data and put it into their own environments, like could be a Salesforce environment on the sell side or something that they built in the middle, like bots, et cetera. So probably take a year or 2 to evolve process and tech, and we're just part of that fabric of industry. In parallel to that, maybe the more exciting in reality is the build out of our enhanced directory and really creating a proper identity phone book for users so that you can be in as an ops person in settlements in cash equity. And so you can be targeted more easily with a fail or client escalation. And that's something that we're working on in parallel, independent. That identity service won't be pinned to Symphony. It's not like an embedded directory as much as it is a directory that we can hang workflows off of with DTC, with OCC, with CME, with LCH, with all the kind of clearinghouses, that are in this game, whether they're in the US securities market or not.
What are your thoughts on tokenized collateral?
I think the word token is an interesting one, and I'm a believer in tokenization generally. I think Jamie Dimon has said people in the digital asset ledger world believe tokenizing of assets either that are pretty electronic or virtual or real, like art and things that are much more physical, buildings, et cetera. And collateral is definitely one of those things that, when you have shortened timeframes or the window's not open, representing the asset is a way. So I definitely believe there's a logic to tokenizing versus moving things actual physically. You just represent it as a token and say, I have that, it's mine, and it's in my custody or whatever. So it will absolutely be something that comes about. At the end of the day, these things are not trivial. They take some time. There's actual legal challenges sometimes to once you move into even a not wet signature, right? There's real challenges in precedent and legal land about when somebody has a right to something or not. I mean, you've seen those things in futures land, right, with REFCO and MF and all sorts of things that got messy. So the tech is probably there. The processes will need to change. The unknown is how long will it take for people to get comfortable that a token of something has you have the same exact right as if it were shipped into your box in a segregated account or something.
How is AI impacting Symphony?
So we did acquire a company, Amenity, at the end of right about in the weeks leading up to GPT launch in 22. So we acquired a business, has dozens of clients, real use cases like earnings call analysis and ESG scoring, greenwashing, lots of different applications we have. So we're in that NLP, AI, machine learning space today. Again, philosophically, we think there'll be step function moments, but there's a lot more incremental movement. And we've been doing this machine learning RPA for some time, that we're going to start to make it more prompt based and feeling more natural than I'm query database looking, sorting spreadsheet by column, which is sort of the endpoint today of like a machine learning process and an RPA, a robotic process automation. So, whether it's just easily finding trades and clients that are more likely to have an exception because of the nature of the instrument, the time of day, and maybe some firm, Japanese bank is great on this, but not great on that. Maybe Barclays or Goldman are better at this or that. So you could start to do some predictive work on kind of swarming places that are going to get noisy. Before that, though, just people tend to there's a lot of time finding needles in haystacks. The first order of business is to create haystacks of needles, and that's an effort. And then you sort those needles, and then you figure out there's sewing, there's crochet, and there's some other weird needles that are totally outlier. And then you get it into the right hands in a way that doesn't disrupt somebody's workflow. So bankers prompting PowerPoints, marketing for sure, responding back to messages with chat bots that give you first, second level support that feels quite human. All those things are here and real, and we don't need science fiction to get value. I think more down the road, all those things will create some value, but it's the intersection of them that are going to create some cubing value that's just very hard to predict how and when, but that's what I've seen. It's the combinations of these things. Here's one example, and I'm sure you have a view on this FMX, Treasury futures thing. Their playbook is to take the clearing and collateral end and make that a big selling point, right? By where they're clearing and the rates complex and all the risk around that. Without connecting all of that necessarily, you can definitely create some AI type outcomes that give you a better sense of, if I do that trade, that's going to be a sort of a balance sheet disaster for me without kind of understanding all the things that could happen that could create that sucking sound of balance sheet for my desk. So I do think as you think of something like that initiative in the futures world and rates complex, I think there'll be AI type workflows there that will help people manage into the value prop of maybe two markets that are, two different pools but related, and then a whole clearing world below that'll be clearly related. So risk people will be getting certain AI tools to manage, traders, portfolio managers, et cetera. And those are all pretty practical today. It's just a matter of the citadels and the smarter firms on the planet doing it, it getting out there a bit, and then it becoming more commodity within the next couple of years.
Was anything else highlighted at Innovate?
What was so different about this Innovate was not just the types of things we were talking about, but the realness of the solutions that were really being pushed by our clients. And then the logos we had up there, which does, not all logos are equal, but we had this really interesting combination of firms doing cool stuff that people don't know exists pretty much at all. And then Bank of America, Citi, Goldman, BlackRock, like real firms on stage talking about the market's innovation. And then we're in that context. So from last year's Innovate to this, we had a lot more sizzle in terms of the name brand recognition. And what they were putting forward was quite tangible and real.
What are your thoughts on Jamie Dimon stepping down in the next 2 to 5 years?
I'm a big fan. JP's a really well-run firm. I respect him a lot. And one of the things he does is he speaks pretty plain English. And he does, run across that red line and has a pretty nuanced way, in a very direct way. Lloyd, I felt blank fine, and I knew him better. He was quite similar. He was not as out there. And by the time he got out there, it was like an 2009 world, which was not great to be out there actually back then. But I definitely think we lose that authentic, truthy, basic man on the street way of speaking. At the same time, JP's a very strong firm. I know some of the folks that are being circled. They have very deep benches all over the place. So, just like Goldman and a BlackRock, like these firms are much more sustainable than they are to any one of these individuals.
Is there a generational divide in the digital asset debate?
100%. I think in generations now, I have this method I work with now, a number method of 40, 10, 3, 190, 62. That's 7 numbers. You didn't hear that. But 40 is 40 years. And I do think you need 2 to 3 generations to make big, big change. And a generation is 20 years. So I think there's the Gen Xers, which are, I think, quite meaningful just based on when we were born and what we've been through a bit. There's the millennials that maybe feel a bit squeezed and then there's this digital native generation, right? They were born into tech. That generation is just going to start to move at an accelerated rate when they start to really run things, where left swipe is more interested than click and file save. And I just think we're about 5 years away from like a bit of a tipping point of a generational move where, and Jamie, by the way, people like him are definitely not boomers in the hashtag boomer. Like they are very forward thinking. They're very innovative, but there's just an element of not understanding things well enough if you're not born into it, or even being a bit axed for the world not to change so much in terms of disruption. So yeah, I think we're 2027, 28 is where I mark, where things will get a bit slopey as a generational change.
Why did you open up in Abu Dhabi?
We did open in Abu Dhabi recently, and there's a whole UAE and there's Dubai, and there's a whole thing going on there where it's really a ramp of a financial center that I personally have never witnessed in as short a time. It's definitely a global thing. I think the Chicago community cares about it a bit. I know some of the massive hedge funds are setting up big time there. So we're not there by accident, and it's kind of an interesting angle. As you look at Singapore, Paris, London, New York, like Tokyo, like this seems to be a real birthing of a major financial center in a good time zone where people will physically move if given an opportunity. Well, I think a lot of it is about cash flow. They generate a ton of cash to invest from Saudi and Abu Dhabi, just from obviously oil. And then they take that and they need to put it in things, which they are through private equity a lot of the time. So there's a huge amount of investment dollars coming through that region. It will also create a lot of private wealth, truly, like family office and pretty wealthy people to cover. But they're really trying to set up a fully functioning market with labor and resource, which is a little different than what you would say could go on in a Singapore, which struggles on labor and it's in a tough time zone for a lot of the world. So it's like Brevin Howard putting 100 humans in Abu Dhabi and all trading strategies and full operations. It's not a trading hub, right? It's a massive center for them building a risk book. And pretty much every brand I know, whether it's BlackRock, Blackstone, General Atlantic, Goldman Sachs, they are all setting up for real in a combination of Abu Dhabi and now Saudi. I think Goldman was the first bank now to get licensed in Riyadh, which we'll focus on that a bit more next year as a firm. But yeah, Abu Dhabi feels quite real as a asset center. And then Dubai is quite real as a place where people will live. And there's a lot of labor there, with 200 nationalities that live in UAE.